Hi there. Real quick before we jump into the episode. If you enjoy this episode, or any of the other episodes, be sure to give us a follow or subscribe. It would also be great if you shared it with a friend, or better yet, left a review so others can know how awesome it is. Thanks so much. And now, the episode.
Hey there, press starters, and welcome to the Press Start Leadership Podcast, the podcast about game-changing leadership, teaching you how to get the most out of your product and development team and become the leader you were meant to be. Leadership coaching and training for the international game industry professional. Now, let me introduce you to your host, the man, the myth, the legend, Christopher Mifsud.
Hey there, Press Starters. Welcome back to another awesome edition of the Press Start Leadership Podcast. On this week's episode, we'll be discussing when raising money feels like Lucy and the football, tempering expectations with investors and publishers, how game developers can navigate funding setbacks, build strong pitches, and sustain hope with investors and publishers. In the video game industry, securing funding can sometimes feel like that infamous Peanuts gag. Lucy holds the football, promising to let you kick it, only to yank it away at the last second. You sprint up, ready for liftoff, and suddenly the ground vanishes. If you've pitched to video game industry investors or negotiated with publishers, you know this sinking feeling well. Understanding how to manage these emotional highs and lows, temper expectations, and maintain momentum is critical for studios of every size. In this podcast, we'll explore why raising money feels like Lucy and the football in our industry context, how to align your hope with realistic outcomes when talking to investors and publishers, and practical, actionable steps to craft pitches, build relationships, and keep your dreams alive, even when the football keeps disappearing. The Lucy and the football analogy and game funding. Charles Schultz's Peanut strip features Lucy Van Pelt offering Charles Brown the chance to kick a football, only to snatch it away at the last moment. For game developers, investors and publishers often play Lucy, and their checkbooks are the disappearing football. Early promises. You pitch a prototype at a conference. An investor expresses enthusiasm, talks about term sheets, and sets up a follow-up. Last-minute pullback. When due diligence begins, suddenly concerns arise. Market risk, team size, IP strength, and the funding vanishes. Emotional whiplash. This cycle of hope and disappointment is draining, yet it's all too common in the video game industry. Understanding this pattern helps you anticipate potential setbacks and build resilience, so you can bounce back faster when the football slips away. When funding feels so elusive. High risk, high expectations. Investors and publishers see thousands of pitches each year. Only a fraction meet their risk-return threshold. The high failure rate of games makes them cautious, leading to last-minute reversals. Information asymmetry. You know your project's nuances intimately. They do not. Gaps in data, unproven mechanics, untested markets trigger new questions, causing them to delay or withdraw. Shifting priorities. Publishers might love your concept in January, but shift focus to live services or mobile in June. Suddenly, your football isn't the game they want to hold anymore. Tempering expectations, a balanced mindset. To avoid constant disappointment, adopt a balanced approach to funding. Hope with a plan. Enthusiasm drives action, but hope alone won't secure a deal. Pair optimism with structured preparation. Multiple balls in the air. Don't pin your future on a single investor or publisher. Cultivate several opportunities in parallel. Vet early and often. Instead of assuming interest equals commitment, ask direct questions about timelines, budgets, and decision criteria at every stage. By tempering expectations, you reduce emotional swings and stay focused on productive activities. Actionable steps we'll cover shortly. Building credible pitches that stick. Great pitches reduce the chances of the football vanishing. Here's how to craft them. Data-driven market analysis. Research comparable game launches, platforms, budgets, time to market, and revenue trajectories. Present a concise market map showing where your game fits. Investors and publishers want proof that you understand market dynamics, minimizing perceived risk. Clear prototype demonstrations. Develop a vertical slice or playable demo that highlights core mechanics and art style. Incorporate rapid iteration from playtest feedback. A hands-on demo conveys confidence in your critical thinking and development pipeline, making the opportunity more tangible. Transparent financial modeling. Provide a 3-year financial forecast, budgets, revenue, cash flow, backed by conservative assumptions and sensitivity analyses. When spreadsheets are crystal clear, the metaphorical football looks less like a mirage and more like a real asset. Team and track record. Highlight prior successful projects, relevant experience, and complementary skills. If you lack a veteran, consider adding an industry advisor. Investors bet on people, not ideas. A credible team reduces their fear of a last-minute pullback. Nurturing relationships with investors and publishers. Securing funding isn't a one-time pitch. It's the start of an ongoing relationship. Regular, value-driven updates. Send monthly newsletters detailing milestone achievements, playtest metrics, and budget burn rates. Consistent communication builds trust and reduces information asymmetry, making it less likely they'll yank the football out at a critical moment. Early alignment on expectations. In initial meetings, ask about the preferred update frequency, acceptable burn rate, and key success metrics. Clarity up front prevents misunderstandings later when shifting expectations cause funding to vanish. Invite to internal playtests. Host quarterly in-studio demo days or virtual playtests where backers can experience progress firsthand. Engaging investors and publishers in the development process deepens their investment in your success, both emotionally and financially. Actionable steps to keep hope alive. Even the most logical leaders need support when funding falls through. Here are practical steps to navigate the emotional toll and maintain momentum. Step 1. Create a funding funnel. Just like a sales funnel, identify stages: lead, pitch, due diligence, term sheet, close. Track progress in a shared CRM or spreadsheet. Aim to have 3 to 5 prospects in each stage. Diversified pipeline reduces the pain of a single rejection. Step 2. Establish an investor playbook. Document successful pitch templates, key data points, and Q&A responses. After each meeting, capture feedback and update the playbook. Continuous refinement increases hit rate over time. Step 3. Build an emotional resilience routine. Funding rejections sting. Develop rituals to decompress, team retrospectives focusing on lessons learned, peer-to-peer support groups, or brief mindfulness sessions. Allocate 15 minutes post-pitch for personal reflection and team check-ins. A healthier emotional baseline keeps your passion alive for the next opportunity. Step 4. Leverage alternative funding sources. Don't rely solely on traditional investors or publishers. Explore crowdfunding, grants, or strategic partnerships. Research platforms like Kickstarter or government art grants. Shortlist 2 or 3 viable alternatives. Additional funding channels provide more footballs to kick. Win the hold'em, win the fold'em. Knowing when to persist and when to pivot is essential. Persist if you've addressed identified concerns, revised your pitch with new data, and still see warm signals. Fold if multiple backers cite the same core issues, such as market size, IP conflicts, despite iterations. Actionable strategy here. Use a decision matrix evaluating factors like investor interest level, project traction, and runway. If the score falls below a threshold, reallocate resources to alternative paths. Measuring your funding strategy's health. Track these metrics to evaluate and adjust your approach. Pitch to term sheet rate. Number of pitches versus actual term sheets received. Time and funnel. Average days from initial outreach to funding decision. Alternative channel contribution. Percentage of budget from non-traditional sources. Team morale index. Quarterly anonymous surveys on confidence in funding prospects. Pipeline health score. Ratio of hot prospects, high likelihood, to total prospects. Deepening your investor conversations. As you progress past initial pitches and into serious negotiations, the dynamics shift. Investors and publishers dig into finer details, your revenue model, team dynamics, and long-term vision. Here's how to navigate these crucial conversations without expecting Lucy to keep the football held up indefinitely. Negotiation mindset, collaboration, not confrontation. Enter negotiations with a win-win philosophy. Instead of viewing term sheets as a zero sum, prepare to ask, how can we structure this deal so both parties feel secure and share upside? A collaborative tone builds trust. If investors sense you're fixated on maximizing your cut at their expense, they may yank back support. Clarify non-negotiables and flex points. Before each negotiation, list your absolute must-haves: IP ownership, creative control, versus areas where you can concede, marketing budget split, milestone schedule. This clarity prevents costly last-minute compromises and shows investors your priorities are rooted in logic and foresight. Use data to strengthen your position. Arm yourself with real-time metrics, early access engagement, demo playtimes, pre-order interest, so you negotiate from evidence, not optimism. Demonstrating traction turns abstract pitch promises into concrete momentum, making investors less likely to withdraw at the finish line. Sustaining momentum when deals stall. Even well-crafted negotiations can stall. Rather than letting your team's morale fizzle, use these strategies to keep progress alive. Parallel tracks, development and fundraising. Continue core development sprints, even at reduced scope, while fundraising. Set a small emergency scope that requires minimal resources but maintains forward motion. Demonstrates to investors that you can execute under constraints and reduce the feeling of the project is on hold. Milestone barbell, big goals, small wins. Structure your roadmap with a mix of ambitious targets, such as beta launch, and bite-sized achievements, UI polish, mechanic tweaks. Publicize each small win internally and externally. Frequent wins sustains team energy and signal ongoing progress to backers, reducing the temptation to yank funding when timelines slip. Re-engage and revalidate. If negotiations stall for more than 30 days, reconnect with investors using new data or milestones. Frame the update as a revalidation check rather than a desperate plea. Keeps conversations warm and demonstrates your proactive, logical problem-solving approach rather than simply begging for money. Emotional resilience, keeping hope alive. Funding cycles can wreak havoc on team morale. Balancing realism with optimism is key to sustaining a healthy studio culture. Normalize the pullback. At your next all hands, acknowledge the peanuts analogy openly. Reinforce that near misses are industry staples, not personal failures. Sharing the common experience of disappointing expectations reduces shame and fosters solidarity. Institutionalize reflection rituals. After each funding outcome, positive or negative, hold a brief reflect and reset session. Discuss what went well, lessons learned, and next steps. Converts emotional energy into concrete actionable steps, preventing morale dips from lingering. Celebrate non-financial wins. Track and highlight achievements unrelated to funding. Press features, community growth, prototype breakthroughs. Keeps the team's spirit high by reminding everyone that success has many dimensions beyond the bank balance. Alternative funding pathways. When publishers and traditional investors keep pulling the football, diversified funding can keep your game moving forward. Crowdfunding campaigns. Plan a Kickstarter or Indiegogo or backer kit with clear reward tiers, polished campaign page, and a realistic funding goal. Leverage your existing community to build momentum. Validates market interest directly and brings in capital without seeding equity. Government grants and tax credits. Research regional grants for digital arts or R&D tax incentives. Prepare concise grant proposals emphasizing innovation and job creation. Non-dilutive funding bolsters budgets and demonstrates institutional support, which can attract private backers. Strategic partnerships. Partner with middleware vendors, platform holders, or IP licensors in exchange for reduced licensing fees or co-marketing support. Reduces upfront costs and provides an in-kind value that preserves cash runway. Long-term strategies. Setting yourself up for success. For sustainable growth, embed funding resilience into your studio's strategic plan. Build a funding roadmap. Map out anticipated funding needs against project phases, prototype, production, launch, post-launch support. Clear visibility on when funding is required and which sources align best with each phase reduces last-minute scrambles. Cultivate a funding network. Maintain relationships with 10 to 15 potential backers, angels, VCs, publishers, grant bodies, through periodic check-ins, invitations to demo days, and personal updates. A warm network means fewer cold calls and more predictable funding dialogues. Institutionalized pitch refinement. After each pitch, document feedback in a shared pitch repository. Regularly review and update your flagship deck, financial model, and demo based on this cumulative wisdom. Constant refinement leads to higher conversion rates and less painful football pools. Measuring your studio's funding health. To stay on top of your financial fortitude, track these KPIs regularly. Funding conversion rate, proposal, the term sheet, average pipeline time, weeks between pitch and decision, diverse funding ratio, percentage of budget from non-traditional sources, runway months, how many months of operation remain at current burn rate, team sentiment score, quarterly surveys on confidence in funding and project viability. Some final thoughts. In the roller coaster world of game funding, raising money feels like Lucy in the football far too often. But by tempering expectations, deploying actionable steps from robust pitch materials and diversified funding funnels to emotional resilience routines, you can keep your studio moving forward, regardless of who holds the football next. So what are your next moves? Audit your funding funnel. Ensure 3 to 5 active prospects at every stage. Launch a small crowdfunding test. Validate interest and gather valuable player feedback. Schedule a reflect and reset session. Normalize lessons learned and set fresh targets. Hold on to hope, lean into logic, and build a resilience that turns every near miss into a stepping stone towards your game success. All right, and that's this week's episode of Press Start Leadership Podcast. Thanks for listening, and as always, thanks for being awesome. Oh, hi. Man, the episode's over, but thanks for sticking around till the end. Be sure to check out more episodes in the playlist and new episodes every week on Monday. Follow or subscribe so you never miss an episode. Don't forget to leave a review. Thanks again for being awesome.